The United States owes over $34 trillion in debt. And for the second time in history, its credit rating just got downgraded. What does that mean for your wallet, your mortgage, and your investments? In this video, we're diving into the recent US debt downgrade, why it happened, what it means, and how it could shake up the global economy. Whether you're an investor, homeowner, or just trying to make sense of the headlines, this breakdown is for you. So, what exactly is a debt downgrade? Credit rating agencies like Fitch, Moody's, and S&P evaluate a country's ability to repay its debt. A downgrade means they believe the risk of default, even if slight, has increased. In August 2023, Fitch downgraded the US from AAA to AA+, echoing a similar move by S&P in 2011. The reasoning? Political dysfunction, rising debt levels, and repeated last-minute debt ceiling standoffs. The government keeps borrowing more while struggling to agree on how to manage spending. And that's not just political theater, it creates real risk. When confidence in repayment drops, the cost of borrowing can go up, which means more tax dollars go toward interest, not schools, roads, or healthcare. This isn't the first time a superpower has seen its credit downgraded. Japan, for instance, lost its AAA rating in the early 2000s. It faced higher borrowing costs, a stagnant economy, and deflation for years. Italy, Greece, and Argentina show even more extreme outcomes when trust erodes. For the US, the last downgrade in 2011 led to a sharp stock market drop, increased volatility, and higher treasury yields. But over time, markets rebounded, partially because the US dollar is still considered the world's reserve currency, a huge safety net. Still, there's a limit. If downgrades become a pattern, that trust can slowly chip away. Here's where it hits home. A downgrade can directly influence interest rates. When the government is seen as riskier, lenders demand more return, meaning higher interest rates on treasury bonds. That cascades down to higher mortgage rates, credit card APRs, and auto loans. Businesses may find it more expensive to borrow and invest. That can slow down job growth and increase the risk of recession. And if investors lose faith in US financial stability, they may shift money to other assets or currencies, weakening the dollar. In short, this downgrade isn't just a symbolic slap. It could raise the cost of living and borrowing for millions of Americans. To sum it up, the US debt downgrade is a warning sign. It reflects deep concerns about governance, fiscal responsibility, and long-term stability. And while it may not spark a crisis today, it plants the seeds for bigger challenges tomorrow. What do you think? Is the downgrade a wake-up call or just financial noise? Drop your thoughts in the comments. And if you're curious about how debt, inflation, and markets all connect, check out my other videos on economic trends and investor psychology. And if you want to stop being a dumb investor, hit that subscribe button. See you in the next video.